All right, hello, and welcome to today's workshop. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. Today is a scorcher here in Orange, California. It's 94 degrees. I was talking to some clients last week that had frozen pipes. So hopefully, for those of you that have dealt with some of that colder weather last week, it's warmed up a little bit for you. Hopefully it's not quite like 94 degrees like it is here. But it is quite beautiful. It is quite nice, but it's definitely air conditioning weather. It's kind of crazy this time of year, I guess. I was speaking to someone, I think it was 2 or 3 days ago, and they said they had a 50-degree swing in temperature between one day to the next, right? So weather's a little bit crazy this time of year, but hopefully you're staying nice and comfortable, you're enjoying your Sunday, and you're having a very, very relaxed day. Today, we're going to continue our conversation around Roth conversions. We talked about it last week a little bit. If you missed our initial conversation, please go back and watch that video so that you can know the context, because we're going to use an example continuing for the case study from last week into this week. But I'm going to bring you 3 major reasons, 3 powerful reasons that you should possibly be considering a Roth conversion. So we're going to jump right into that today, and I hope you enjoyed today's training. If you're watching this at another time, go ahead and leave a comment down below, and I'll be happy to answer any questions you have. But if you're here live, then welcome, and we'll be chatting about everything that you need to, well, I shouldn't say everything. It's just really 3 things that you need to know about considering an early Roth conversion. So what that means is really taking out money from a pre-tax account like a 401k, moving it over to a Roth account. Earlier than you would normally draw it, you would be paying taxes at that time on the amount you moved over, but there's very powerful strategies that can really be beneficial to you later in retirement that, if you do proper planning, can really set you up for a good tax planning and really, in actuality, a lot more control over your finances. So that's what I want to give to you. I want to make things simple. I want to give you control, and I want you to know how to be smart while you still have time, because once you get later in those retirement years, it's just not a whole lot of things you can do to protect yourself against some of these things like extra taxes and what we're going to talk about today. So hopefully we're going to jump right in here. I'm going to make this window a little bit smaller today just so that I'm out of the way. I might even jump off here. But so 3 powerful reasons to consider a Roth conversion. Okay, so as always, before we jump in, I have to put up my disclosure. And I want you to please not take what I'm telling you today as direct advice for your situation. This is meant to be for informational purposes and should be taken as such. So it's not tax advice, it's not legal advice, it's not financial advice. But what I want to do is open your mind to something that you may have not known about and you may not understand the impact of, because you might not have ever worked with an advisor. You might not have ever worked with anybody that's helped you with anything around your taxes, for your tax planning for retirement or your investment planning for retirement. So hopefully this brings you some insight and really opens up your eyes. But keep in mind, it is for informational purposes. Okay, so one big reason, one powerful reason to consider a Roth conversion, okay, is that you're going to be moving to a lower or no tax state in retirement. Okay, so I have a lot of folks that are moving from states like, which I'm going to show you here, the worst of the worst, California when it comes to taxes, to other more friendly states, things like Florida, North Carolina, Nevada. There's a lot of friendly states, much more friendly states than California, pretty much all 49 of the other ones. But if you're planning on moving later in retirement, then it could make sense to consider deferring taxes today. So that means putting money in a pre-tax account like a traditional 401k or traditional IRA. And then post-retirement, and then most likely pre-Social Security, so if you have a gap between those two, considering moving some from your pre-tax accounts to your Roth accounts before you activate like both Social Securities. If you take one, there's still usually some room, but once you take both for you and a spouse, a lot of times the benefits go down quite a bit. So let me talk to you about that a little bit here. Okay, so even if your income does not change, right? So let's say, you're going to be at $60,000 of income before retirement and $60,000 of income after. Just by dropping the state income tax requirement for your 401k or IRA distribution, you could be keeping up to 13.3% more money by contributing to a pre-tax account today and then planning for conversions post-move/retirement, okay? And the 13.3 is only one state that goes that high. Again, it's my lovely state of California here. But it is beautiful, the weather's nice, and it is what it is, okay? So if you're in one of these states, Okay, for 2019, these are the states with the highest income taxes. Okay, so we beat out Hawaii. It's amazing. Okay, and then on top of that, we actually don't even get a deduction for putting money in our health savings account, also known as an HSA. We actually pay tax on that here too. So, people ask, why do you stay here? It is really beautiful. I tell you, it is a great place to live. But I think when I move to retirement, I'll probably end up looking at some other places because it just doesn't make any sense, But I can defer taxes today if I like in my 401k, and so I don't have to worry about it quite as much as I would later down the road. Okay, number 2 is Hawaii, 3 is Oregon, 4 is Minnesota, 5 is Iowa, then New Jersey, Vermont, New York, Maine, and Wisconsin. So, these are just the states with the highest income taxes. So I have clients, I think, in all of these states, by the way, and maybe not Maine, but it's just painful, right? It's a little bit painful. So, there are some states that do not tax things like pensions and IRA withdrawals. I didn't consider that in this. I just wanted to show you the highest income tax states because if you're pre-retirement and you're putting money away, this is probably more important to you, okay? All right, and then here are the states with the lowest, or for the majority, is no income taxes, right? So if you want to move to a lower tax state, these might be some states you want to put on your map, all right, or put on your consideration list, right? I know a lot of people, a lot of people are moving to Tennessee. A lot of people are moving to Nevada, Washington, Texas, Florida. Not too many in South Dakota and Wyoming. I think you're pretty safe there for now. In Alaska, you're probably safe for a little while. You've not heard, Alaska is amazing. I want to go visit it. But New Hampshire as well, and then Pennsylvania rounds out that top 10 list with the lowest income taxes. So something you have to be cautious of, though, is some of these states do have high sales taxes, for example, right? So things that you'll be purchasing, when you buy things at the store or whatnot, there are higher sales taxes there to make up for some of this. So you want to do some research as you're narrowing down your options if taxes and tax planning is going to be one of your considerations for retirement. I really think it should be secondary. It could be a good reason, but you should really find somewhere that you really enjoy, that you maybe have some friends or family at, and that you really like the environment of, because at the end of the day, you won't be paying that much in taxes for most people. So if you hate the environment but you're paying zero tax, it doesn't really make any sense. I lived in Las Vegas for about 4 months. The first 2 months were great. By month 3, I started not really enjoying it. By month 4, I was ready to get out of there. I know some people love Vegas, and that's okay. But for me, it was just too much after that amount of time. So back in California, I am. So number 2, this is a really interesting one. Okay, this is one that I actually didn't know about. Well, I guess I knew about it, but I didn't really think about it until I read an article recently by a very smart gentleman. I think his name is Jeffrey Levine. He's a CPA. And really, really interesting here, okay? So by Roth conversions can help you avoid what is called the widow penalty, okay? So this is for you married folks, okay? If you're married and one of you passes away early, then you may be susceptible to what we're talking about here called the widow penalty, all right? So this is very interesting. I never thought about this until recently, okay? So even if you have a very modest retirement income of, let's say, $60,000 per year, which is pretty common. I know some people live off less than that, but a lot of people live around $60,000 all in, including, vacations, home, taxes, all that kind of stuff. And if one spouse passes away, then the remaining spouse goes from a 12% bracket to the 22% bracket, just like that. And you have about a couple years, okay? So you get to claim, your spouse, I believe, is for 2 years post, losing them. And again, I don't mean to talk about this in such brash terminology. It's just, these things happen, right? So I want you to be smart. And, I'm all about planning, right? I'm a certified financial planner, which means we want you to plan and create a good plan for the future, okay? So if this were to happen, and let's say you have an income of $60,000 per year, because you have things like your Social Security coming in, maybe a pension, and then your required minimum distributions, well, you can go immediately from 12 to 22%. And this could even be as high as 25% if the tax brackets reset in 2025. Okay, so these are things that you really want to be considerate of as you're mapping out your retirement plan. And if you're thinking about doing things like I'm talking about here, like partial Roth conversions, then this could be really important for you, okay? So the surviving spouse will also have more tax-free money if they need it. So even if their normal income would be in the 12%, once your income goes over $40,125, and that's in 2020, they will be in the 22% bracket, right? So I guess I wrote that kind of funky, so let me explain that. The surviving spouse will have more tax-free money if you're doing partial Roth conversions, okay? So even if their normal income would be in the 12% bracket, if you want to take money out of something like an IRA or 401k, then obviously that becomes taxable income. And if in the single person's bracket for 2020 is only going to be $40,125, that's pretty low, okay? So even if your income need is lower than the $60,000 I mentioned in the previous statement there, and you don't need much more, but then maybe you want to take some money out to do things like travel or whatever it may be, or maybe to give some to the children to help them out. If you're single, you file as a single filer in 2020, if you go over $40,125, you'll be in the 22% bracket. So in reality, that's really not a lot. What does that work out to per month? About just a little over 3,000. So 4,125 divided by 12. So 3343. Okay. So if your income needs to be over 3343 a month, then partial Roth conversions might make sense for you to be considering. Okay. And this can be especially problematic after 70 and a half years old and required minimum distributions start kicking in. Okay. So RMDs have changed, and there is an update on that. So I'm going to pull you up something cool here. I think it's pretty cool. If you guys want this, I can drop this down in the link too. So as you may have heard, there's most likely going to be an update on the RMD, the required minimum distribution amount. Okay. So here's the old ones, the current ones, I should say, and then here's a new one. So these are being proposed. And there's also been talk of delaying RMDs to 72. The comparison is actually going to be pretty close, is what it looks like. So whether they do 72 or just or update the table here, you're going to probably end up in the same place. So there has been a decrease, in the first year of about 0.21%, and then some. But for a lot of people, they don't, and this is just 3.44% in the first year, down from 3.65. But that's just from your pre-tax accounts, right? So if maybe you don't need that much from your pre-tax accounts because maybe you have some taxable money like a brokerage account or some cash you want to live off of, well, it's not going to matter. You're going to have to take this out. And as you get down here in the later ages, this number goes up quite a bit. So let's say you had, a $500,000 portfolio, for example, and if you start with $500,000 at 62, it's probably going to be a lot higher, but let's just say you had 500,000 at 70 and a half. 3.44% of that is going to be 17,200 you have to take out, right? And if you have $1 million, it's going to be 34,400 you have to take out. And if you have $2 million, it's going to be 68,800 you have to take out, right? So these numbers can add up pretty quickly. Doesn't seem like a lot, but it creeps up, right? It creeps up. And if your goal is to live off a certain percentage to keep you below things like the earned income limits for IRMA, which we'll talk about in a second, then this might really blow your plan out of the water and not only cause you to have to take more out of your 401k or IRA than you want to, but it could also increase your cost for Medicare, I think it's Part B, but increase your cost for Medicare, and just a lot of other things start adding up, okay? So it can be very problematic. So let's talk about that just a little bit here. Okay, so a big thing that you need to know, and this is currently, right? So there's been talk that this may not hold true forever, but I really would be disappointed and surprised if this went away, okay? Money that's converted to Roth is exempt from RMDs, right? So RMDs are required minimum distributions, or what we just talked about. They start at 70 and a half, and then they increase each year going forward. So this can be very, very problematic for people that have things like either really good Social Security base, because let's say I've seen many people that they may need $4,000 or $5,000 to live off of, but they're getting $4,000 or $5,000 from their Social Security alone, so they don't really need to touch their retirement accounts. And so when these RMDs kick in, this is like $20,000, $30,000, $40,000, $50,000, $80,000 that's getting kicked off as income every year that's being taxed at your top tax bracket, and it's just painful, right? It's just absolutely painful to deal with. So money that's converted to Roth is exempt from RMDs. So having money in Roth accounts can also be very powerful from a tax planning and distribution strategy standpoint. So let's say, for example, you had, let's say the next year's tax bracket for married filing jointly is about $80,000. Okay, it's just over $80,000. It's going up from $78,950 to just over $80,000. So let's say you had a pension coming in for $45,000 a year, and your two Social Securities were coming in between you and your spouse, and that was an additional $35,000 a year. So you got $80,000 of income, and this just using simple math. Obviously, you have a little bit of room there. You have standard deductions and things that'll come into play. I'm just using this as an example. Let's say you had $80,000 of income of AGI, adjusted gross income. So obviously a little bit higher. Well, if you wanted to take more money out, by every dollar you took out beyond that would go from a 12% tax rate to a 22% tax rate, and maybe at 25 by the point you need to draw it if the tax bracket's reset, as they're expected to do in 2025. So by doing partial Roth conversions early, and I'm not saying to go convert all your account in the same year. That's not what I'm saying. To do little bits early can be very, very powerful from a tax planning and distribution standpoint. This can also be very powerful for people that want to retire before 59 and a half, right? Currently, the only option to get money out of your retirement accounts from a traditional retirement account like a 401k is the standard 55 rule, right? Where if your plan allows it, at 55 or later, if you retire from that company, you can start drawing money from your 401k. You can also do substantially equal periodic payments, which is a 5-year payment plan. You can do that from your IRA as well. But maybe you don't want to take that money out all those years, or maybe you want to retire even earlier. Well, if you have more money in a Roth account, you can always take your contributions out tax-free and earnings out after you pass the 5-year rule. So these can be very powerful not only for folks later in retirement that are trying to control their tax brackets post RMD requirements, which is post 70 and a half, but also for folks that want to retire early that may be able to do so because they were good savers and investors, and they don't want to wait until 59 and a half to be able to draw on their accounts. And then, as I mentioned earlier, being able to draw money out of an account without worrying about bumping into the next tax bracket or paying IRMA. Okay, so many of you have never heard of IRMA. IRMA stands for Income-Related Monthly Adjustment Amount, okay? And what that is, it's on your Medicare premium, which for a single filer starts at $85,000. And the thing is like, it's a little bit higher. I think it's about $170 for dual filers, which is a lot higher. But if you were to face something early, and we'll talk about that in a second, like if someone passes away early, you could be paying a lot more, not only in taxes, but in IRMA. So by having some money in Roth accounts, where if you need to pull a little bit along the way to do things you want to do, it can be very useful if you plan on enjoying more of your assets in your go-go year. So we have the go-go years, which are kind of like the first years of retirement, maybe 5, 10, or 15. Then we kind of have the slow-go years, which are kind of that in-between, maybe 75 to 85. And then post-85 years, which are called your no-go years, where mostly your family's come to visit you or things like that. You're not out sailing the world, which maybe some of you are. I've seen people still driving to the store every single week, and they're 103 years old, right? So I think we're going to see people living a lot longer, but just for contextual purposes, okay? So let me go back here real quick and show you an example, okay? I'm going to show you an example here. So let's talk about this. So this is the same example from last week. So if you want to see my assumptions and everything, you can go back to last week's workshop and view that. What I want you to look at here is a couple things, okay? So this is sort of what the taxes are going to look like. And this is in California, by the way. So this kind of light blue is California state tax. And then once you hit dark blue, this is the federal tax, okay? So in this case, we're not taking Social Security till later. We're going to be living off some money we have. So we don't really have any taxes besides California state tax because they're just lame compared to even the federal tax brackets. And then we have this gap in here. And then up here, we kind of hit this spot where we're never really going to see lower taxes forever, okay? We're never really going to see lower taxes forever in this case. So what we want to try to do here is do some planning, okay? And in this case, what we'd like to do is instead of having no Roth conversions at all, we're going to look at converting up to the 10% bracket, okay? What I want you to notice first here is that without any conversions, by following this strategy for taking out their brokerage accounts first, then their pre-tax accounts, they're going to have $63,000 more. If we were to convert early on here, before we take Social Security, up to the 10% tax bracket, we're now going to go up to $159,495 more. Okay, lets you get to keep because you're going to be paying lower taxes. The other thing I want you to notice here is how much the income drops. So if you look here at the income drop, I mean, you may not be able to see this, by the way, but I'll do my best to describe it. The top line there, this is at age 75. Adjustable taxable income with conversion is only supposed to be $35,344, and adjustable taxable income without conversion is expected to be $59,236. Okay, this is without any vacations put in, by the way, I don't believe. So let me add some vacation in there because I think you probably want to spend some money, and we'll talk about this. So let's add. We do have some vacations in there. Okay, good. So we have some vacations in there. That looks good. Everything else looks good there. Perfect. Okay, but what would happen if somebody passed away earlier? Okay, so right now we have our co-client planning to pass away at age 90. Okay, what if they happen to pass away early at 72 and then the other client lives until age 90? Okay, well, what happens is we start having a lot more problems and the taxes get a whole lot higher down the road here. So if we don't do any conversions, as you can see here, and hopefully you can see this, at age 78, let's just say age 77. And these clients, by the way, are the same age. Okay, so client 1 passed away at age 70, or excuse me, client 1 is still alive. Client 2 passed away at age 72. So they've gotten past the period where they can claim their widow on their taxes. Now they're in the married filing single tax bracket. So they are now, as you can see here, the 12% bracket is only at about $54,417. So they are easily, clearly, always going to be in the 22% bracket. And this, again, if this resets in 2025, this will be a 25% bracket. Okay, this will be a 25% bracket. But if this client was smart and planned early, as you can see here now, their income is no longer in the 22% bracket. It's at $44,049 at 74, which the 12% bracket is $51,795. And they're going to cruise right below this 12% bracket for a really long time. Okay, they pretty much stay under it forever for the most part, it looks like. So let me know if you can see this. Okay, so if they don't do a conversion, okay, let's take this off. If they don't do a conversion, their income at about 73 because of their RMDs is going to start at $50,937, which they jump above the 10%, above the 12% bracket at that point. And then every year going forward, they are just solidly up in the 12% bracket. And this is including accounting for things like the standard deduction and everything else. But they're going to be there forever pretty much, way up in the 12% bracket. Okay, so way up in the 22% bracket. So in this case, at 83, their income will be about $91,408, and so about just under $30,000 of their income, about $27,000, is going to be paid at the 22% bracket. If we do a conversion early on, okay, and we're only talking about doing these for a few years here, okay, so we're looking at these years here. Move some stuff out of the way. So we're looking at, in these years, converting 34,000 the first year, 36 the second year, 41 the third year, 44 the fourth year. And then once we get kind of down the road here, we run out of cash in this situation because we're using the cash to live off of. And so we have one small conversion later, but we're only doing it for 5 years here. Okay, so just doing these conversions for 5 years. When we get to this age where our spouse passes, as you see here, if our spouse was still alive, we'd still be in the 10% or 12% bracket and we'd be fine. But since our spouse passed at 72, and now we did conversions, we're at $44,049 and the 12% bracket ends at $51,795. We stay in this 12% bracket almost forever. It looks like way down the road here, we start creeping up, but this is at 85, okay? So 85, 86, we don't know what can happen by then. But just imagine, this is the 22% bracket we're talking about here. It could be 25, and it could be even higher going forward. So the power of tax planning and the power of doing conversions early not only can help you stay in a lower tax bracket if everything goes perfectly and you and your spouse both live until 90 years old, but if you were to have somebody pass away early and you lose the benefit of married filing jointly, and you have a lot of tax-deferred money, Well, we can really keep a lot of your money from being taxed because we converted it early. So when we look at this, what it's going to look like here is our conversions at 63 through 67. You're going to see them over here on the tax-free account balance. They're going to start adding up. So we have 34,707 just like here. Then we're going to add the 36,827 plus some growth, and then continuing through here, right? So now we're starting to build up this Roth account. And even though we don't really add anything after 67, we add a little bit here. But even though we don't add anything after 67, because we got this big chunk of money over, now it's going to grow tax-free, and we're going to be living off our tax-deferred money the whole way. And so this couple, by the time they get to about 79, actually this person, let me set it back here for a second, actually, because I currently have them passing away at 72. Let me move back to 90. Okay. So as we get down the road here, we are going to have some RMDs that are coming out that we don't need, right? So what's going to happen is this is your taxable account balance, is your tax deferred and your tax free. You're initially going to draw your taxable account balance down, and then you're going to start living on your tax deferred balance. But eventually, you're not going to need all the money that's coming out from RMDs. So the RMDs are going to start kicking out, and now you're piling up a bunch of taxable money here, which you have two choices. You can either leave it in cash and try to get 2% or 1%, whatever it's going to be, or what most people will do is reinvest the money they don't need, and then now you're facing capital gains every year. So you got money coming out from your RMDs. So in this case, we're looking at like $40,000 a year, $48,000 a year, $50,000 a year that's coming out. We're also going to have taxes most likely on some of our taxable money, the brokerage money we have here. And so it's just a lot of pain in the neck, right? A lot of pain in the neck. So these are things that I want to help you avoid. So I'm going to pause here and see if there's any questions. And if there's no questions, then I'm going to throw up my website here. While I'm waiting for some questions to come in, if you would like to chat with me about your particular situation, and if you would be a good candidate for Roth conversions, and here's some good overlying criteria. This is not the perfect criteria, but it's a good underlying criteria. If you have a lot of tax-deferred money, so if you have a lot of money in 401ks or traditional IRAs, very minimal Roth money, and then you have some money that's outside of your retirement accounts, like whether it's cash or a brokerage account that you could use to pay some tax along the way. So for example, if you only have $5,000 of cash and everything else is in a tax-deferred account, it's most likely not going to make sense. You need to have some money outside of there. But if you're somebody who has a lot of tax-deferred money, and you know that between your Social Security, your other fixed income sources, whether it's pensions or annuities, you're not going to need to draw a whole lot of your retirement accounts unless you choose to, well, then you're probably a really good case for something like a partial Roth conversions. So this is why I really think it's important that if you're early on in retirement or you haven't retired yet, to have a conversation about this and to get some actual numbers done for you and your spouse, or just you alone if you're not married, because the impact, as you can see here, can be massive, and the amount of tax savings could be in the thousands of dollars every year for as long as you live if we get this right. So question came in, and Bob asked, how do you know how much to take out early? Bob, you really have to do the numbers, okay? So everybody's going to have a different situation. I've seen people where it doesn't make sense at all. I've seen people like the example here we have where it's only up to the 10% bracket, right? So if you were to take Social Security early, well, you're really going to have very minimal money you can take out. So in this case, we delayed Social Security until 70 in my case study here. So it made a lot of sense because we have no money coming in anywhere else except from our conversions. But there's plenty of people that it makes sense to go up to the 12% bracket. And then there's a lot of people as well that makes sense to go to the 22% bracket, because if they don't, they're going to be even higher after the RMDs kick in. So Bob, for my advice for you is to actually get some advice on your individual situation so that you can see what makes the most sense for you, okay? So taking the things, account things like Social Security income, pension income, things that once those start, they're not going to be going down. And then look at where your current and future tax brackets are expected to be, and then make your decision based off of that, okay? All right, next question here is, let me just pull it up actually. Let me pull this up, okay? And I'm gonna throw up my website here. Okay, so Leanne has a question here, and it's big. Let me make this a little smaller. Okay. Would it make sense to do a partial Roth conversions if you would have to take more money out of your traditional IRA to pay the tax on money you converted? Generally, I don't like doing that. I generally do not like doing that. I don't think that's necessarily a good idea. It could be worse ideas. And Leanne, again, it's going to depend on your individual situation, because let's say you did have to do that and you paid some extra taxes on that money, but then down the road it's going to save you $5,000 a year or something like that forever. Okay, then we talk about it. But in general, you don't want to do that. And you don't want to pull money out of a Roth either to pay these taxes, ideally. So this is what I'm saying. For people that have some brokerage accounts, or, I know a lot of you folks are sitting with a bunch of money in cash that's not doing anything, and you need to have a mission for that cash. This could be a good mission for it, and it can really help you out later down the road, okay? All right, so hopefully that answered your question, Leanne. Let me get this out of here. All right, and I think Dick just has a comment. Sometimes 10 years is not enough time for a conversion. Yeah, I mean, sometimes it's not, but a lot of times it is. Let's say most of the people that I'm working with are, trying to retire somewhere between 57 to 67, right? That's the general range of people that I normally work with, sometimes younger, sometimes older. But a lot of people want to retire by then. So if even if you're 66 or 67, but you haven't taken Social Security for you or your spouse, you may still have at least a few years to move some of this money over. The problem is, once you take Social Security and you're moving this money over, well, now you're increasing your income. So if you go over what are called the provisional income limits, which we've talked about here many times before, if you go over the provisional income limits, well, now you're going to be taxed on your Social Security, right? So if you're paying, if you're being taxed on 50% or 85% of your Social Security, well, then the net benefit of moving that money over, it gets reduced. So these are just things that people that, I wish things were easy, guys. I really wish things were easy and that you can do all of this on your own. But from what I find, most people that just spend hours and hours on the internet just trying to figure all this out on their own, they usually end up having one or two really critical errors that if they would just gotten like professional guidance where someone can help you put the whole puzzle together and do the right things at the right time so that, the right hand's working with the left hand, then those people end up in a lot better situation. So that's what we do, and I'm happy to chat with you, no cost, okay? So if you want to schedule a call with me, you go to keepitsimplefinancial.com/talk. You find my calendar page. You're going to find that appointments are very limited until the end of the year here. Holiday season's coming. We've got a lot of things going on. But before December 31st, if you're looking to consider a Roth conversion, you have until December 31st to do it, okay? So end of the year, pretty much every year, I'm going to be talking about this because I know how beneficial it can be for folks to be thinking about this and being really smart early in their retirement or even pre-retirement, so that later down the road, you have control, flexibility, and you're giving Uncle Sam the least amount of money that you could possibly give, okay? I don't have a problem paying my fair share. California, I don't think it's a fair share, by the way. I think they take more than their fair share here. But federal taxes, I think, are actually pretty darn fair. I don't think they're that bad overall comparatively to what it could be, and you look at other countries. But we don't want to give away $1 more than we have to, right? We want to keep as much of our hard-earned money as we can, and through smart tax planning, through really good decisions, and maybe using strategies like partial Roth conversions, these things can be really beneficial, and you'd be surprised, like I showed you on the other screen, it could be a six-figure impact to your overall wealth, right? So anyways, that's enough for me for today. I appreciate y'all watching. I hope you really enjoyed this, and I hope you saw this as a benefit. I'm going to put the link down in the comments as well if you want to click on it and schedule a call. Other than that, if you have any other questions, leave me a comment. I'll do my best to respond. Have a wonderful Sunday. Stay cool if it's hot like where it is where I am, and I'll see you guys on the next one. Bye-bye now.